Wolfspeed Inc. is currently trading at $50.31 per share, representing a sharp intraday climb of 11.4% as of Wednesday, May 13, 2026. This sudden spike in the price of Wolfspeed shares is catching many off guard, especially considering the heavy turbulence this ticker has faced over the last year. While many retail investors using a Robinhood app or checking their individual brokerage might see this as a simple technical bounce, the reality under the surface is much more complex. This move comes on the heels of a massive restructuring effort that has completely reshaped the company's financial identity. Most people looking at their Fidelity mobile app see a semiconductor company that has struggled with debt and high capital expenditures, but the recent $476 million debt refinancing and the strategic reclassification of ownership following regulatory clearances have injected a level of liquidity that the market simply wasn't pricing in. The expectation was a slow, painful grind toward profitability, but the reality is a company that just aggressively cleared a path through its most expensive liabilities, reducing annual interest expenses by over $60 million in one fell swoop. There is a common belief among those involved in self-investing that Wolfspeed is a high-risk gamble stuck in a capital-intensive trap. This narrative is easy to buy into because for a long time it was true. Building out massive silicon carbide fabrication facilities like the one in Marcy, New York is not cheap. However, if you look at the recent institutional activity and trading volumes, a different story begins to emerge. Large-scale buyers are starting to treat this more like a specialized materials play rather than just another chip stock. When you look at high-end portfolios like Schwab Intelligent Portfolios, or those managed through Interactive Brokers trading, the weighting of silicon carbide players has been shifting. The traditional silicon chip market is crowded, but the wide bandgap semiconductor space where Wolfspeed operates is a different beast entirely. It is the backbone of the next generation of power electronics, yet the stock was being traded like a legacy manufacturer on its last legs until very recently. The tension here lies between the gap losses people see on their Fidelity brokerage screen and the non-gap progress occurring in the fab. Wolfspeed recently reported consolidated revenue of about $150 million, which hit the midpoint of their guidance. While the gross margins are still technically negative, the narrowed gap suggests that the efficiency of their 200mm and 300mm substrate platforms is finally beginning to scale. Investors often get spooked by negative numbers, but the smart money using an Interactive Brokers platform is looking at the $1.2 billion in cash and short-term investments the company still holds. That is a massive war chest for a company with a market cap that had recently been compressed so severely. The curiosity loop for many is why the stock is soaring now when the net loss was still significant. The answer lies in the removal of the bankruptcy cloud that followed the Apollo Global Management news from mid-2025. By emerging from that restructuring period and adopting fresh start accounting as of late 2026, the company has effectively wiped the slate clean. If you are currently holding Wolfspeed or thinking about picking up shares on an individual brokerage, you have to look at the macroeconomic pressures and the sector momentum. The shift toward electric vehicles and renewable energy systems require the exact type of power MOSFETs and Schottky diodes that Wolfspeed produces. While competitors like ON Semiconductor or ST Microelectronics are formidable, Wolfspeed's focus on the entire silicon carbide materials chain gives them a unique vertical integration that few can match. This is why you see such high volatility and unusual trading volume on days like today. Institutional traders aren't just buying the stock, they are buying the scarcity of the material itself. Those who use Interactive Brokers fees as a metric for frequent trading might find the spreads here tightening as liquidity improves, which is a classic sign of a stock moving from a speculative avoid list to a serious accumulate list for many long-term portfolios. Comment below how many shares of Wolfspeed you currently hold, or if you are waiting for a pullback before entering. It is important to gauge the community sentiment here, because the retail versus institutional divide on this stock is wider than almost any other in the semiconductor space. When we talk about online investing and the tools available today, like SoFi Invest or various investing sites, it's easy to get lost in the noise of daily swings. However, Wolfspeed's business model is a long-term play on physics. Silicon carbide is harder, handles heat better, and allows for much smaller power systems than traditional silicon. This isn't just about making chips, it's about making the entire electrical grid more efficient. This is the common ground where the market narrative and the company's reality meet. People know the tech is good, but they doubted the execution. Now that the CEO, Robert Fearley, has stabilized the ship, and the CFO has drastically reduced the cost of capital, the reality is starting to exceed those low expectations. The risk is no longer just about the company's survival, it's about how quickly they can capture market share as the global demand for 10 kV silicon carbide power MOSFETs increases. Looking at the history of this company, it's worth noting they were formerly known as Cree Inc., a name synonymous with LED lighting. Their transition into a pure-play silicon carbide power company was a massive bet that many thought would fail. They sold off their legacy LED business and doubled down on a future that hadn't yet arrived. For years, the stock price reflected reflected the pain of that transition. But if you're using Fidelity ETFs or Fidelity mutual funds that focus on semiconductors, you've likely seen Wolfspeed's weighting fluctuate wildly as they move through this phase. The company's headquarters in North Carolina has become a hub for this specific technology, and their recent push into European markets with a planned factory in Germany shows that their ambitions aren't limited to North America. They are positioning themselves to be the global standard for high-voltage power applications. The future outlook for Wolfspeed remains tied to the pace of infrastructure development. If governments continue to push for domestic chip production and renewable energy adoption, Wolfspeed is in a prime position to benefit from federal grants and tax credits. However, if the transition to EVs slows down or if competitors catch up on the substrate manufacturing side, the stock could see another period of consolidation. The reality is that Wolfspeed has a head start on the 200mm and 300mm wafer sizes, which are much more cost-effective for large-scale production. This technical advantage is what keeps the buy ratings coming from places like Piper Sandler and Susquehanna, even if their price targets vary significantly. When you are looking for investment help or researching through intelligent portfolio tools, you have to weigh these technical moats against the very real operational risks of running a state-of-the-art fab. Managing a position in a stock like this requires discipline. Whether you are trading through Robinhood investments or interactive brokers, the volatility will be high. The daily swings of 5 to 10% are not uncommon for Wolf, especially around earnings or major industry conferences. This is why many investors prefer a diversified approach, perhaps including Wolfspeed as a satellite position within a broader group of tech stocks like Nvidia stock, Apple stock, or Tesla stock. Each of these companies is a potential customer or partner for the technology Wolfspeed is developing. For example, the power inverters in high-end electric vehicles are a major market for silicon carbide, and as those companies scale, Wolfspeed's order book tends to grow with them. This creates a ripple effect throughout the entire tech sector that savvy investors can use to their advantage. In summary, the story of Wolfspeed is a classic case of the market overreacting to short-term debt struggles while ignoring long-term structural advantages. The recent price action at $50.31 suggests that the tide is turning. We have moved from a period where the narrative was dominated by bankruptcy fears and high interest rates to one where the focus is on innovation and financial flexibility. The expectations were that Wolfspeed would be forced to sell off assets or dissolve. The reality is that they have refinanced, reduced their debt, and are now sitting on a billion-dollar cash pile with their most advanced manufacturing facilities finally coming online. This contrast is exactly why the stock is seeing such aggressive buying pressure. As the company continues to execute on its fiscal 2026 goals, the gap between what investors expected and what the company is actually delivering will likely continue to drive the stock's valuation. Authority in the stock market comes from being able to see these shifts before they are fully reflected in the price. And for Wolfspeed, the shift from a debt-ridden manufacturer to a lean, tech-heavy leader is now well underway. Maintain your focus on the substrate yields and the institutional accumulation phases, as those will be the true indicators of where this stock goes next. Whether you use Fidelity Iris for long-term holding or SoFi Active Investing for shorter-term plays, the fundamental change in Wolfspeed's balance sheet is the most critical factor to watch in the coming months. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.